guys, I'm Rose, and today I'm going to talk to you about some metrics, some signals that might predict if we're headed for a stock market crash in 2019. I'll also give you some tips on how to recession-proof your portfolio and even position yourself to make money from a stock market crash. So if this sounds good to you, then keep watching. Since the last big recession in 2008, the S&P 500 has almost doubled in price. And if you count from the very lows of that recession, the S&P 500 has more than quadrupled in price since then. So the stock market has been doing extremely well for the last 10 years. In fact, it's been on the longest bull run in history. Based on the market's historical patterns, the market is cyclical and goes through a recession roughly every 7 years. So we're long overdue. The strength in the stock market right now has been due to a number of factors. Obviously, the US economy has been doing really well. There's lots of growth, low unemployment. But also the Federal Reserve has been keeping interest rates super low and printing lots of money. And they've printed trillions of dollars in the last 10 years. This results in the system getting flooded with cash, and this cash has to go somewhere. So the market has been going up largely because there's nowhere else to put all this money, not necessarily because market fundamentals are strong. How do I know that fundamentals are out of whack? Let's take a look at the Wilshire 5000 to GDP ratio. This is an indicator that Warren Buffett watches. The Wilshire 5000 is a market index that tells you how the US stock market is doing as a whole. It's a lot more comprehensive than the S&P 500 because it includes all US stocks, not just the 500 biggest ones. Logically, the stock market is linked to GDP, and GDP is linked to the stock market. When you invest in the stock market, you're essentially investing in companies that sell products and services, and that's what the economy is, companies selling products and services. So it wouldn't make sense for the economy to grow without the stock market also going up. On the flip side, it doesn't make sense for the stock market to go up a lot if the economy doesn't grow with it. It's not a perfect lockstep relationship, but they should kind of jive with each other, right? It's just common sense. If you look at the Wilshire 5000 to GDP ratio, most recently it was right around 1.26. And you can see that it's higher than where it was right before the last two stock market crashes. So this is the first signal that tells me we're poised for a stock market crash. When the stock market is trading so high without the GDP to justify it, a correction is bound to happen. It could be this year, next year, the year after that, who knows? Timing the market perfectly is impossible. But the Wilshire GDP ratio is definitely telling me to be more careful at this point in the cycle. Another signal is the inverted yield curve. Typically, the 10-year interest rate is usually higher than the 2-year interest rate. The longer the loan period, the higher the interest rate. And why? Because when a lender locks up their money in a loan for a long time, they know they'll have to forego other investment opportunities with that money until they get paid back. So they need to get compensated for that. But now that the yield curve is inverted, what that means is that lenders are charging more interest for shorter term loans than the longer ones. So the 2-year rate is now higher than the 10-year interest rate. This could imply that lenders think there will be lesser investment opportunities in the future because the economy is slowing down. So they're okay with accepting lower interest rates for longer term loans. It's quite technical and I don't think anyone really understands it, nor is that necessary. But what we do know is that since the 1960s, the yield curve has inverted before every recession. And the recession doesn't happen right away, and it could be a while before anything happens. But again, the inverted yield curve is just a signal that tells you to be a little more careful at this point in the cycle. Now let's talk about some ways to recession-proof your portfolio and actually position yourself to make money when the next recession happens. Obviously, if you're planning to retire soon, you probably want to start moving some of your money from stocks into more stable things like bonds and cash. Because if you have to start living off your nest egg pretty soon, then you don't want to risk that nest egg shrinking at all. But if you're still young and don't really have investments yet, then the recession is going to be a really great opportunity for you to buy a lot of stocks very cheaply. Here's one of my favorite quotes from Warren Buffett. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. In other words, the stock market doesn't crash very often, but when it does, everything will be on sale and you'll want to buy stocks in the truckloads. It's the exact same concept when there's a big sale at the grocery store. Like when Whole Foods is doing a 5 for $5 deal on my favorite yogurt, I load up. So you want to be ready to do the same with stocks. So one way to recession-proof your portfolio is to have some cash reserves in there rather than having 100% tied up in investments. Now's the time to start socking away cash, putting a little money from your investments into cash, and that way you'll have some dry powder to deploy when the crash happens. And meanwhile, you want to use this time to also build up a watch list of stocks that you want to buy. Make a watch list of the companies that will survive a recession and come out stronger than ever. What do I mean by that? Whenever a recession hits, the weak companies go out of business, and the strong companies that are still standing, they end up taking over that market share and come out of the recession even stronger. The key to finding these kind of companies is to look for the ones with a super strong competitive advantage. Warren Buffett calls this a moat, an economic moat. In other words, something that sets that company apart from the competition that will ultimately help them stay on top. Yes, these companies still suffer during a recession, just like everybody else, but they don't suffer as much because they have an edge over their weaker competitors. You also want companies with a manageable debt load, because too much debt is going to kill you during a recession when your revenues go down, but you still have to make fixed payments on your debt. So you want to take a look at the financial statements, see what kind of debt payments they have relative to their cash flow, and evaluate if they have enough cushion there to weather a downturn. It's impossible to know exactly when a recession will happen, but when it does, you want to be ready. You want to know which stocks to buy, at what price, and you don't want to be scrambling to do research amidst all that chaos and fear. And I know it sounds kind of mean, but when everyone is panicking and selling, you want to be the one buying. And ultimately, you'll end up with a portfolio of investments that you understand really well because you did your research beforehand, that you've bought at a great price because everything was on sale, and that you're proud to own. I think a lot of people my age tend to stay away from stocks because they don't trust the stock market right now, and they prefer to invest in things like cryptocurrency. But never forget that the stock market has made a lot of people rich ever since it came into existence, and it will continue to do so, regardless of what happens in the short term. There is still a ton of money to be made in the long term. Now I want to hear from you. How are you positioning yourself ahead of a recession? Are you investing at the moment, or are you waiting on the sidelines and sitting in cash? Join me in the comments below, and let's help each other make better investing decisions. If you liked this video, hit that subscribe button below and share this video with your friends so we can open up the conversation around money and build a sisterhood of financially savvy, empowered women. Always remember to go after your dreams unapologetically and to live life on your terms. Cheers.